So tell us about this market that we're in. You obviously are a distressed debt expert, your firm, but you do some other things as well. Where are we in this cycle and what are you seeing out there?
Well, we've been saying for some time at Oaktree that it's getting a bit late in the cycle. And as a result, we're continuing to move forward and invest, but with an extra dosage of caution. Oaktree is more than just a distressed debt investor. You're correct that right now the amount of available distressed debt around the globe is not as robust as it has been in the past, especially tradable credit. But we're still finding some very interesting private situations, a lot in Europe and more in Asia. But all the while, Oaktree has continued to grow a number of other strategies that have been taking advantage of the excellent growth around the globe and this strong market in real estate, the emerging markets, both debt and equity, infrastructure, and more in direct lending.
Well, and I want to dig into several of those areas, but let's go back to what you said about global growth, because that obviously has been the story for all stripes of investors. How confident are you, how confident is your team about how much longer that will continue?
Well, we generally don't predict with any great degree of certainty at Oaktree, but I would start by saying I think that the growth we're seeing around the globe is real. We're seeing synchronized growth, really. Strong corporate earnings reports. Valuations are quite high. We have the impact of the tax cuts and the stimulus from that, and the stimulus from the repatriation of foreign profits still to come. I think we're starting to see capital expenditures pick up. And we have a very pro-business administration in Congress right now, and also a loosening of regulations. So this is real, and this is very positive. I consider all of these tailwinds. At the same time, there's headwinds out there.
Right, and let's talk about those, because some of those may be geopolitical, if not geoeconomic. How do you model those in? How do you factor those in if you can?
With a high degree of caution. So sort of the obvious headwinds right now at the top of my list would be interest rates. And they've moved up, and there's a direct correlation between higher rates and lower financial asset valuations. And I think there's upward pressure, especially since the central banks, starting with our Fed, have announced they're really going to start taking away the punch bowl in terms of the quantitative easing and other stimulus measures they've been engaged in. I also think there's a headwind from just the sheer huge volume of debt that's been issued since the global financial crisis, not only in the United States, not only corporates here, but around the globe. And further, a lot of that debt is of a relatively low quality, with very few covenants to protect lenders, by way of example. And then, in addition to these sort of known headwinds, there's a lot of wild cards, I'd say. Inflation seems to be picking up, and despite some of the numbers people talk about, if you're filling your tank on your car with gas, or you're trying to buy a home or pay rent on an apartment in various places around the country, you're feeling much higher price increases than these headline index rates that are moving up. There's a lot of geopolitical risks. I think you're as well aware of those as I am. We have a non-traditional president that's hard to predict. We've got important talks starting today with China, and where that will lead with additional tariffs and possible trade wars. We've still got concerns about cyber and cyber breaches. I don't think we've seen the end of changes in the regulation of technology companies and the possible blowback from consumers over privacy issues. And there's probably others. So we pay attention to those. We tend to not predict.
Right.
We continue to move forward and invest, but we're cautious in doing so.
So take us inside the conversations that you have with your big institutional clients. You've got pensions, sovereign wealth funds, endowments, all of those sorts of people who are counting on you to obviously make the right decisions as they think about how to invest in this market that, as you say, has been, a low interest rate environment. They need yield. What are they coming to you and asking for, or what are they responding positively to when you bring them opportunities?
Well, you're absolutely correct. We're fortunate at Oaktree to have a roster of some of the most important and sophisticated institutional investors around the globe. And there's a lot of similarities across our different types of clients. The corporate and public pensions, the foundations and endowments, the insurance companies, the sovereign wealth funds. And the commonality is that they need to get a certain level of return because they have obligations or liabilities on the other side to their pensioners, to their insurance policyholders, to the citizens of those countries who are dependent on distributions from the sovereign wealth funds, to the charitable organizations that depend so highly on charitable contributions from foundations and endowments. And so they've, over time, in this lower for longer rate environment, as a general matter, have had to take on more and more risk to try to achieve the level of return that they need.
And where are they finding the right balance of risk? What types of sort of sub-asset classes are most popular with them?
Yeah, I'll mention that in just a second, but the big trend is that they're not able to find those kind of returns any longer in the highly liquid tradable credit markets and tradable equity markets. And so we've seen increasing flows to alternative asset managers like Oaktree, where those institutions are basically trading off additional risk and less liquidity and having their funds tied up for a longer period of time in exchange for the prospects of higher returns. We've seen it across the board at Oaktree. We've seen it with our real estate platform, moving from opportunistic real estate investing to real estate investing focused more on achieving income in the form of higher quality buildings, good tenant rolls, rents, but also real estate debt. We're seeing it in private debt, oftentimes referred to as direct lending, to especially small and medium-sized companies where many of the banks, post the global financial crisis, have retrenched somewhat from lending to those corporates.
And I want to ask you about that specifically, because that seems like when we hear from your peers, whether it's KKR or Ares and Blackstone and others, that seems to be a place where people are really piling in because there is such a need. How competitive is that market at this point?
The market's competitive. All the markets we compete in are competitive, and they always have been. But one of the things we've observed at Oaktree is that over time, at different parts of the cycle, the supply of opportunities tends to trump the amount of available capital. By way of example today, just thinking about distressed debt, there's about, industry estimates, about $150 billion of dry powder dedicated to distressed debt. Compare that to the fact that between CCC high-yield bonds, CCC senior loans, and the prospects for fallen angels from the BBB investment-grade bonds, the lowest ratings, in a normal cycle where we might see a recession or a slowdown, that number is estimated to exceed well over $1 trillion of prospective opportunities. And so at different points in the cycle, the opportunities will emerge. In the interim, we are still deploying quite consistently at Oaktree our capital, maybe a bit slower than some of our competitors, but our clients have come to us for a certain amount of risk control and downside protection in their investing, and we want to deliver what we've promised. So we're thinking long-term, protecting the downside, continuing to be value-oriented and opportunistic, and if that means we slow down the pace of deployment from time to time in certain strategies, so be it. It's good for the long-term results for our clients.
One thing I wanted to make sure I asked you about today specifically, KKR had some news this morning that they're converting from a partnership to a corporation. It's a mini trend of sorts that we are seeing in some of the publicly traded alternative managers. Clearly, this is a response to the tax reform that we've seen here in the United States. Oaktree is in a similar position, being a publicly traded firm. How are you thinking about this at this point?
Well, we've been studying this for quite some time, and I think it was fairly expected by the market that first Ares and then KKR would convert to a C Corp. At Oaktree, we're going to continue to monitor it and watch it. One thing we know is just how much we'd give up by converting to a C Corp and taking on double taxation right now, even with the lower corporate tax rates of 21%. What we're not sure of is what we'll get for it, and that depends in large part on the valuation multiple expanding over time. And we will watch our competitors, we'll root for them to see how this works out, and if at some point in the future we conclude it makes sense for Oaktree, then we'll move forward.
And do you feel briefly that public investors are starting to understand this asset class now that it's been in the public markets for a decade or more?
I do, and as I meet with investors, they understand it, and I think, frankly, they're very, very impressed with it. The challenge for investors, though, is that the alternative asset managers, including Oaktree, are fairly difficult to model. We have three general forms of income: our management fees, our investment income, and our incentive income or performance fees. And at least the latter two are difficult to model. They're cyclical by nature. They're based on trends in the markets, opportunities that come and go. The one thing we know is I think we're generating really good economic returns over time. And we have a view that over the long term, Oaktree and the competitor companies will deliver strong returns to investors.